products. Some won't have explored or come to an expert like yourself and done some exploration if they can achieve a better rate. So I guess it's just to briefly speak about if someone was sat on a variable rate product, and they can often be expensive, let's be honest. Like, what are their options, and what could you potentially help them do?
Okay, so in the last 12 months, as the interest rates have gone up, the bank base rates have risen as well. So there's a huge proportion of people that have fallen off very, very competitive rates and fallen foul of these higher variable rates. In some cases, I've seen variable rates for landlords' mortgages at 9 and 10%. So huge sort of shock factor in terms of increases into mortgage payments. So in terms of options, I would say the first thing is to always reach out to an independent mortgage advisor to research the market and see what options exist, because individual circumstances will differ. Different properties will come into play, and obviously criteria varies massively depending on circumstances and property and of course rental yields, etc. But one of the things that we do as a team is we will consider firstly what mortgage products might be available to you for staying with your existing lender. Now, product switches, as we know them, have become very, very popular with lenders over the last 5 years. Before then, the market was very small and retracted, and particularly in buy-to-let mortgages, there wasn't a product switch or product transfer market necessarily. But lenders have got wise to offering these very, very attractive rates that clients can stay on to try and keep them with that particular lender. Now, that's really useful if a landlord is going to struggle moving lenders for whatever reason. So it might be that the rental yields are very difficult now, the property's empty, all these sorts of things, because importantly, there is no underwriting whatsoever with a product switch. So as long as the loan to value stacks up, it really doesn't matter in terms of what's happening with that property, whether there's a tenant in there, what the rental yield looks like, whether it's part-way renovation. It really is just as simple as choosing a product from your existing lender's range. That's one angle that we look at for clients, but we also compare that to the open market as well, and we'll be looking at different lenders and what products can be available for switching onto something more competitive.
I know this is something your team have done a lot for me, actually, because every time I get a mortgage statement, I'm sort of emailing it in and thinking, is there anything that can be done with this mortgage product? And as you've suggested, I know for me, our product with the existing lender is a lot less costly, potentially, than a full remortgage.
Absolutely, and as I say, there's no underwriting, so it doesn't matter whether the circumstances have changed massively since you bought the property or remortgaged it last. It's really just a case of selecting a mortgage product that falls within the loan to values, and typically a lot of these mortgage switch products do allow for a higher loan to value tier as well. So interestingly, if you were to go to the open market and look for a buy-to-let remortgage product above, say, 80% loan to value, you would be massively restricted. But a lot of the lenders that offer these product switches will allow for unusually higher loan to values than you normally would see on a buy-to-let. So you shouldn't find yourself in a position where you're almost like a mortgage prisoner sat on a variable rate, because they do cater for where there's been a slight reduction in equity and there's an even negative equity as well.
Yeah, I have to say, I know some of the cases personally that your team have looked at, I've been genuinely surprised by the saving that they've been to have. Just by looking at an existing lender and fixing a product. There was a number of cases where, and it was several £100 a month across those cases, which is obviously gratefully received, helps keep the portfolio more sustainable.
Absolutely, yeah.
I have to say, in fairness to you, I didn't have a great deal to do, because you guys take care of it, so that's even better.
These are notoriously easy to arrange because of the fact that we're not providing any documentation to the lender, we're not providing details of existing portfolios in the background. We are literally just looking at a product and making that application and choosing the start date that the client requires. So it's easy to do. There's a lot less costs involved. There's no solicitors needed or anything along those lines. It's a very, very straightforward process.
Excellent. Now, I've got a feeling that the next question is a very similar answer and a sort of similar exploratory process, but
Yeah. Yeah.